Welcome to the latest in Fitch's series of global virtual investor meetings. We have one-on-one meetings with hundreds of investors each year and want to give you a glimpse inside these meetings. I'm Rui Pereira and I head up Fitch's North American Structured Finance team here in New York. I'm thrilled to be joined here today by Grant Bailey, who heads our US RMBS group. Welcome, Grant.
Thanks, Rui.
Grant, let's start by focusing on home prices. So home prices in the US have steadily risen since 2011. Is this the year that we start to see some leveling off, given tax reform, given the backup in mortgage rates? What's your current home price outlook?
Right. Home price growth in the U.S. has really been strong, and it's unlikely that it's going to slow down anytime in the near future, just because of the solid economic growth and the limited supply of homes for sale.
Are there parts of the country that you see as being more vulnerable to a downturn?
Yes, there are a handful of areas where it looks like the strong housing market has led to momentum that's caused prices to overshoot. In the major cities in Texas, in the Southwest, in Phoenix and Las Vegas, in the Northwest with Portland and Seattle, all of those cities look to us, they're about 10 to 15% higher than what we would expect, even after you consider the strong economic growth and the strong population growth. And those are the areas that we think would be most vulnerable to an unexpected economic downturn.
Let's talk a little bit about asset and rating performance. So U.S. RMBS performance has been really strong the last few years, so upgrades outpacing downgrades, and there's still a very large percentage of the portfolio with a positive outlook. What's driving the strong performance, and is it sustainable?
The biggest driver of performance in RMBS over the past 5 to 6 years has just been the incredibly supportive macro environment. Since reaching its trough in 2012, home prices are up more than 50%, and that's really driven a lot of improvement in the performance of the legacy RMBS transactions, and that's translated into a lot of upgrades. And post-crisis, the post-crisis RMBS deals have been very good quality. The structures have been very supportive of ratings, and we've seen a lot of positive rating pressure across all the subsectors: prime, GSE, RPL, non-prime. The vast majority of the classes issued between 2011 and 2016 have been upgraded.
And when you look at the various subsectors within the non-agency space, where are your chief credit concerns these days?
We're still feeling good about the credit outlook in general, but each of the subsectors have specific risks that have been increasing over the last year or two. In GSE risk transfer transactions, the credit quality is still significantly better than it was prior to the crisis, but it has been weakening over the last couple of years. In RPL, we're seeing an increasing percentage of loans that have a shorter and shorter reperforming period. In non-prime, we're seeing an increasing percentage of loans that have non-traditional income documentation, or for some loan types, no income documentation. Mm-hmm. And we're working to incorporate those risks and those trends into our rating analysis and our credit enhancement, and that's limited our participation in some subsectors as other rating agencies have been more willing to give issuers higher ratings.
Great. Let's talk a little bit about volume. So 2018 is proving to be the strongest year from an issuance standpoint since the crisis. Has the market finally turned the corner? What's the state of the non-agency market?
Right. Issuance activity in private label RMBS has been relatively high. Despite often being the most conservative rating agency, we've rated over 50 transactions over the past 12 months, which is the highest 12-month figure we've had since the crisis. But overall, the private label RMBS sector is still only about 1% of the total mortgage securitization that's happening in the U.S. So about 99% of mortgage securitization is coming through government-backed programs. And the Trump administration has been focused on finding a way to shrink the government's footprint in the mortgage sector. And early next year, the director who oversees Fannie Mae and Freddie Mac will be replaced with a Trump appointee, and it's possible that change leads to some changes in the activity in the private label space.
Do you think that there's ample demand from investors to absorb significant amounts of supply?
I'm not sure, to be honest. I mean, we're definitely seeing investor interest in new issue RMBS grow and recover, but there's still a number of investors, traditional RMBS investors, who remain on the sidelines for various reasons. One reason for some investors is a concern that potential conflicts of interest still hasn't been sufficiently addressed. Reps and warranties, for example, still have meaningful differences from issuer to issuer, and that makes it harder for investors to get a clear understanding of what risks they're exposed to on any specific transaction. And I think rating agencies can add value on something like that by identifying the differences clearly for investors and incorporating it into a consistent way in their rating analysis. And that's what we've tried to do with reps and warranties, for example. We have a scorecard that we provide and publish publicly. And just in general, in RMBS, over the next couple of years, as the market evolves, we're going to continue to look for ways to help investors keep track of the changes and make credit decisions.
Great. Sounds like we stay on a path for gradual recovery over time. Thank you very much, Grant, for your insights and joining me. Next up in our series will be virtual meetings with our global colleagues, so watch this space for new content. If you have any questions related to any of the topics that we covered, send an email to the address on the screen. Thank you all for watching.